good day. This is Sherwood Tucker with American Ag Marketing and Trading Company from downtown Chicago, and I wanted to put together this PowerPoint presentation for you on the turtle trading system rules for beginners. I'm going to go over this pretty quickly to try to get the video so it fits on YouTube. I can get it all up in one shot. So if I do go over it too fast for you, here's my contact information. If you have any questions, you can visit our website, americanagmarketing.com, or give us a call direct, 312-987-2072. And my email directly is on the website as well, so feel free to email. Before we get started here, I have to go over a couple disclaimers for the futures market, since we are dealing with instruments of risk with the futures contracts. So here they are. Futures markets involve substantial risk and therefore are not suitable for all investors. The information contained herein in this presentation is believed to be from reliable sources, yet no guarantee is given to its accuracy or completeness. And this presentation is solely for educational purposes. Nothing herein should be construed as a solicitation to buy or sell futures or commodities. Although that would be great if you did like the presentation and you felt comfortable with us and wanted to do business with us. Always accept new accounts. So before we get started on the exact rules and philosophy of the turtles, I wanted to outline just my years of experience in the business. I found this kind of interesting because everybody, when they first get started, they're looking for the holy grail or an entry strategy, that system that will help them profit in the markets. So if you read the book Market Wizards, which is a great book, it's by Jack Schwager, there is a few quotes in there that I wanted to go over, and one concept that I got out of all of it, which is pretty unique. So right here, Jim Rogers, who's a real well-known investor, is quoted as saying, "I haven't ever met a rich technician or technical trader." Marty Schwartz, I always had to laugh at people who say, "I've never met a rich technician." I love that. It's such an arrogant, nonsensical response. I used fundamentals for 9 years and then got rich as a technician. On diversification, John Templeton, diversify your investments. William O'Neill, diversification is a hedge for ignorance. On averaging a loss, meaning if you're in a trade and it starts going down and you buy more, you have to understand the business of a company you have invested in, or you will not know whether to buy more if it goes down. That's Peter Lynch, obviously successful. And then William O'Neill, averaging down is an amateur strategy that can produce serious results. So obviously they're contradictory on that philosophy. On picking tops and bottoms, Peter Lynch again, don't bottom fish. And then Bernard Baruch, don't try to buy at the bottom or sell at the top. Maybe the trend is your friend for a few minutes in Chicago, but for the most part, it is rarely a way to get rich. Jim Rogers again. And then Paul Tudor Jones, who's a real well-known speculator, successful, actually still in the business, doing real well. I believe the very best money is made at market turns. Everyone says you get killed trying to pick tops and bottoms, and you make all the money by catching the trends in the middle. Well, for 12 years, I have often been missing the meat in the middle, but I have caught a lot of tops and bottoms. Common denominator, what it all boils down to in trading, and any one of these guys will tell you, and my viewpoint is you always got to focus on the losses, and that's where all these guys agree. They might differ on their entry strategies, what works for them as far as making money, but they all do agree on this one point on losses. Jim Rogers, my basic advice is don't lose money. Marty Schwartz, I'm more concerned about controlling the downside. Learn to take the losses. The most important thing in making money is not letting your losses get out of hand. Paul Tudor Jones, I'm always thinking about losing money as opposed to making money. Don't focus on making money, focus on protecting what you have. William O'Neill, the majority of unskilled investors stubbornly hold on to their losses when the losses are small and reasonable. They could get out cheaply. But being emotionally involved and human, they keep waiting and hoping until their loss gets much bigger and costs them dearly. Bernard Baruch, learn how to take losses quickly and calmly. Don't expect to be right all the time. If you have a mistake, cut your loss as quickly as possible. And Ed Code, the elements of good trading are cutting losses, 2 cutting losses, and 3 cutting losses. If you can follow these 3 rules, you may have a chance. The turtle system was actually born from 2 gentlemen, Richard Dennis and Bill Eckhart, over an argument. They were trading partners together, and they disagreed on the nature versus nurture philosophy. Whereas Richard Dennis, he believed that average people would be trained and taught specific rules in order to become successful traders. Bill Eckhart believed that traders were born with it. Either you had the talent or you didn't, and you couldn't be taught correctly how to trade. because it all comes down to psychology, really. The turtles were put through a rigorous training program and given $1 million each to trade in real time. Where their system focused, and basically their system, what it outlined and went into was the markets, which ones did they want to trade, corn, cattle, lumber, position sizing, which was one of the most important aspects of their trading system, how much do you buy or sell given your account size and equity at the time, their entry method, when to buy or sell, as far as timing, their stops, where to put your stop losses to get out of a losing trade, exiting winning positions, and then tactics, how to buy or sell, how to place orders specifically. The rules of the markets they traded at the time, and we're going back here a little bit, were the indexes, interest rates, coffee, sugar, cocoa, cotton, currencies, gold, silver, and copper, and the energies. And what it all really revolved around is they were the most liquid futures markets at the time. Some of these might have changed a little bit, and now there's some new markets that might be even more liquid. So they wanted to stick to the most liquid markets. So if they had to get out where they got caught in a position, it wasn't as drastic in a super thin market. So position sizing, and this is probably going to be the toughest to explain. They used an algorithm that was advanced for its day. It normalized the dollar volatility of a position by adjusting the position size on the basis of the dollar volatility of the market. And I'll explain this here in a little bit in detail. The reason they did this was because positions in the market that moved up and down a large amount per contract would have an offsetting smaller number of contracts than would positions in markets that had lower volatility. They just wanted to keep their positions and the risk associated to their account equity at the time balanced is what they were looking for. And the key, even if the volatility of a specific market was lower, any significant trend would result in a sizable win because you would be holding more contracts of that lower volatility commodity. So they used a concept called N, and what N is, it represents the underlying volatility of a particular market. So if you're talking about corn, for example, and N is simply the 20-day exponential moving average of the average true range. And it represents the average range in price movement that a particular market experiences in a single day, accounting for the opening gaps, etc. And here's the formula for the daily true range. It's high, low, high minus PDC, PDC minus low. High equals current low, low, current low. I'm sorry, H is current high, L current low, and PDC equals the previous day's close. So the first step in determining their position size was to determine the dollar volatility represented by the underlying market's price volatility defined by its N. Their initial stop was always placed 2N away, which is pretty far, as you'll see, but we'll get into the whole concept. And that represents 2% of their entire account's equity. So if you had $1 million account, a $5,000 account, a $5 million account, your position sizes obviously would vary because you'd have to balance out the amount of contracts given a 2% loss for each trade that you were going to take. So here's a chart and an example with the corn futures. If you take a look at this chart, let's see here. Corn is $50 per cent. At this time, the N was 17 cents, or $850 US per contract. So that represented one N. As an example, if you had a $250,000 account, we're looking at how many contracts could you initiate a position with using the turtle rules, given the N, and given their buy and sell criteria. So to explain that, the initial stop, as we talked about, goes 2N above or below where you buy or sell the market. 1N equals 1% of the account equity. So for a $250,000 account, it would represent 1N being $2,500. Therefore, 2N would be $5,000. So in our example of the March corn having an N of 17 cents or $850 per contract, 2N would equal 34 cents or $1,700 per contract. So given the $250,000 account, the maximum allowable risk per the initial position is 2% or $5,000. Using 2N as the initial stop, you'd be able to buy or sell 2.9 for 3 contracts, because if you were stopped out 34 cents away from your entry in this sample, you'd lose about $1,700 per contract or $5,100, which would equal the 2N. Again, if you have questions, feel free to email me or give me a call. I can go through this with you in more detail. As far as their entry rules, very simple. And again, they didn't really put that much attention on their entry like most traders out there do when they're first getting into the markets. They think that entry is everything when it's really not. They had two sets of criteria. The first was enter the market, either buy or sell it if the market price exceeds by one tick the high or low of the preceding 20 days. So if you get a new 20-day high or a new 20-day low, you'd be buying or selling, initiating the position. The System 2 entry criteria was exactly the same, except they used a 55-day period instead of the 20. They had a filter where you would not initiate the trade if the last trade for that market would have resulted in a winning trade. So here's an example of buying a market based on their criteria with a 20-day high or low. You have a breakout here above the 20-day high at 581, and their initial stop would be placed 2N away, 74 cents at 507. One of the most important things, and a lot of people do run into trouble with this, is cherry picking. So when Richard Dennis and Bill Eckhart were training the turtles, they told them to be very consistent, take every single trade that came up on the system, even if they gut feeling was they didn't feel good about it, because really the whole year could come down to 2 or 3 really big winning trades to offset your losers, commissions, transaction fees, that type of thing. So if you did skip a signal because it didn't look quite right or you didn't feel good about it, would greatly affect your return for the year. And it did. If you went down the turtles, their performance, they all varied greatly because they all cherry-picked trades. They didn't stick to the rules. The one turtle that did make the most money was Curtis Faith, and he wrote a book about that. And the reason was he said he just stuck to the rules, and he did take every single trade. It came down to one trade, which was in heating oil. Moving on here. Their exit rules also pretty simple. And so you know, on their entry strategy, if you broke down the statistics, they would really only win on 25% of the trades. 75% of their trades were losers, but they followed the system, they put their stops where they needed to be, and they controlled the risk. Specific exit rules on their System 1 was a new 10-day low for long positions, a 10-day high for short positions, and every unit in that position would be exited if the price went against the position for a 10-day breakout. System 2 was a 20-day high or low, whereas the entry was based on the 55-day breakout. Another thing, too, is they have money management, which I can't get into on this presentation, where they would add to positions if they were going in their direction, which would maximize profits, obviously, if the market kept going. Here's a graphic representation where this system, 20-day breakout, entered, went up, came back down, hit a 10-day low. Even though it did reverse off of it, you would be stopped out at that price level, following the rules. And yeah, great detail did go into the turtle's exit and the psychology. Exits, I think for most people, are probably the most difficult part of trading because people cannot hold on to winning trades. It's not too hard to cut losers. I mean, for some people it is. They end up riding losing trades to the detriment of their account. Once you have a winner on, though, it starts burning a hole in your pocket, and you seem to focus on that market more because every time it goes against you, you just feel money being ripped out of your pocket, basically. And that's what happened to a lot of the turtles as well. It does take great discipline to hold on to winning trades, and with this system, waiting for a 10 or 20-day low, like we just talked about, could mean watching 20, 40, 100% of your profit go out the window. But that's what you had to do, and that was the discipline if you were going to follow the rules.